Bryant, it seems as though value has taken the baton from growth so far in 2025. Where are you seeing it the most?
We came into the year thinking that the fundamentals for the Mag 7 were going to collide with the other 493. And as the Mag 7 goes, so goes growth. So as earnings growth rates compress, the valuation beginning to split, and we're seeing value take over. And so it's played out well across all market caps in the US, small, mid, and large.
And particularly in healthcare, that's a sector you're watching very closely. Why is that?
Well, the healthcare right now is under a lot of stress from the policy bark. But I think that bark's bigger than the bite. And so what we're seeing now is opportunity to start to dip your toe into healthcare stocks, looking for companies that are going to invest through this noise and not around the noise. So healthcare looks interesting to me right now.
Well, there's certainly a lot of noise in the market with regard to tariffs. How do you mitigate the risk among the stocks that you pick, the companies that you're choosing for your portfolio?
We want to own companies that ultimately have a unique competitive advantage that we can measure through pricing power. Tariffs are just another way of increasing prices across the cost of goods sold bucket. If a company has an advantage around that allows them the ability to raise prices, that ultimately will allow them to see themselves through it. So focus on competitive advantages and pricing power, and we'll navigate this just fine.
And are you focused on the Fed as well? Last year, we were supposed to get about 6 interest rate cuts. Now they're actually talking about 5 this year. Who knows? What do you think?
I think the Fed is handcuffed and in a box right now. I think right now they can't do much of anything. They're waiting for the hard data, and that's the right thing to do. But ultimately, we're going to see the economy contract a little bit. We're going to see unemployment rise, and we're going to see inflation come down, allowing the Fed to step in and do their normal job. Let's just not bet on it to happen right away. The market usually has a number of cuts wrong. It'll come around eventually.
So there's a lot of folks watching the market who want to play the Fed. They make their forecast according to their Fed predictions. But you also now have to watch President Trump and his latest move. How do you do that?
We try to figure out what's going to happen, not when it's going to happen. The when is too tough right now. But what's going to happen seems obvious. We're going to see a little economic pain to see long-term gain for the U.S. economy. We're going to shift spending from the federal side to the private side. We're going to see that shift down to middle income to low income spending. We want to move our capital along that same trend. We just don't know when it's going to all play out, but it's happening in that direction.
So finally, as we're feeling that pain, and we are feeling that pain, which areas seem the ripest to you for investment?
If we assume that eventually rates will come down to support the market, we're going to see the benefit to home builders. We're going to see it to building products. We're going to see it to companies that ultimately rely on that lower end consumer who needs that lower cost of capital. And so we're pushing capital there. And then outside of that, we're looking again at healthcare as a unique place to put capital to work today.
All right. Well, thanks a lot for coming on and talking about it.
It's always a pleasure.